Hello and a very good evening to all of you. This is your tutor for Practice to Pass webinar of the ATX exam for the September 2021. My name is Mia Saad Muhammad and I welcome you all on behalf of ACCA. Can all of the attendees raise their hand if they can see my screen clearly and can hear my voice as well? Okay, thank you. So guys, let's quickly move on to our today's plan. For today, I have selected two 35-mark questions primarily. One is Lamar. This question is from the September-December 2020 attempt. This used to be available on the CB practice platform till last semester or the last attempt. However, ACCA has now replaced it with the very latest exam, that is March-June 2021 exam. So I will suggest all of you to attempt that complete exam as well. It will be a very good practice before going into the exam. But for you, I have selected this question, the MAR, and the second question is Grand Limited, which is from September 18 attempt. Both of the questions are of 35 marks. There were a few students that have asked me that, sir, will we be doing 35 mark questions? And I've told them that I have dedicated day 4 for the 35 mark question. So guys, today we will discuss what are the differences of 35 mark question as far as the topics are concerned, and how the requirements are different from 25 mark question or 20 question as far as the 35 mark questions are concerned. We already knew that the examiner has stated that there will be a 5 mark of ethics either in question number 1 or question number 2, but both of the questions that I have selected today does include a 5 mark ethic part, so we will revise our ethics concept as well. With that, I will be discussing a technique of as to how you should read the 35-mark question, because its requirements are even on the, and the information is even more scattered as compared to question number 2. And the reason is that the amount of information the 35-mark question has is the maximum as compared to the other questions. And obviously, due to such more marks, or the marker has much more freedom to test more topics. So however, another good thing is, the more lengthier the question is, the more easier it is for you to gain marks in it. Why? Because there'll be more marks for every point. Because for example, if there is a requirement of 16 marks, obviously there'll be a lot in that. So if you'll be able to score like 5-6 marks in that by doing 5 to 6 points correctly, at least you can score that marks. However, if there is a part for 4 marks and you don't know about anything about that, there is a very less margin in that part to earn marks. So there is one way that student look at the question number 1 as a very difficult and a lengthy question. However, I look at as a different way, because it includes 4 professional marks, as well as it may include 5 ethical marks as well. If this question does not include ethical marks, obviously the question number 2 will include them. So let's move on to our today's question. Meanwhile, if anybody has any questions related to anything, please post it in the question section. You can download this Lamar question from your handout section of the software. So let's quickly go to the question, and as you will read the requirements first, I'll zoom it out a bit more for you guys. Okay, so as I told you in question number 2 as well, which we were doing, or the 25 mark question, that requirements of these questions are merely marking schemes. Rather, you will find the detailed requirements above these marking scheme. So here you can clearly see that this does not tells us anything but the marking scheme. And at the very bottom, you'll always see 4 professional marks. This will always be part of question number 1. They cannot be part of any other question in the exam. However, for ethics, the examiner may choose either question number 1 or 2, but for professional marks, it is obvious that they will be part of question number 1. Now, let's quickly read the requirements. Knowledge obtained from advising other clients. I think by the look of it that it is the part that relates to ethics, and its marks tells me the same story. Now, investments in J Limited. Okay, then we have 3 parts related to that part. Residency of J worth 9 marks, election to exempt the overseas profit of J Limited worth 3 marks, and then CFC rules for 3 marks. And then we have another topic, purchase of investment property for 5 marks, and then a proposed gift of shares to trust on 1st November 2021 for 6 marks. I guess the last part relates to IHT. For C, I have to check to which part does it relates. Uh, for B, I tell you that it relates to corporation tax. So the more chunk of the question is tested from corporation tax. 9 plus 6, almost 15 marks have been tested from corporation tax. So usually what happens is, I've told you this before as well, that the examiner always either try to test individual taxes as part of question number 1, or majority of the question is usually on corporation tax on VAT or VAT. So let's move on to the bit detailed requirement, which you will find here. Extract from your manager. Same is the case with question number 2 as well. And if this question, if you came across in the CB practice platform, there will be 3 tabs on the left side of the screen on which you have to click one by one. One will be the requirement, one will be the extract from email, and then one will be the scenario. Now, as we have discussed yesterday as well, the good technique to answer these questions usually is to kick out the parts that have smaller marks and read the scenario related to that part first. But I told you that is only for the reading perspective. When we will start writing the question, what we should do is that we should write the answers in the chronological order, because we have already thought that as to which part we know the answer and to which we do not have the complete information. Now, moving to requirement number 8, knowledge obtained from advising other clients. We have number of existing clients which trade from permanent establishments situated overseas, and few years ago we had a client with a presence in the country of Korea. That's fine. Set out the points you will make in order to explain the extent to which Rep Limited can benefit from the knowledge we have gained from advising these other clients. So I told you that in ethics there are several types of question, and one was, you can find the ethics portion in my income tax notes, and one is new clients or the prospective client. I guess this relates to this part. Now coming back, what we can do is we can quickly go into the scenario and read about this thing. There you can find one by one the details, potential investment, purchase, proposed gift, things like that. So to kick out this part first, that what are the factors that we should keep in our mind before advising the client. Now, I can have an idea, because I haven't read the question in full, that if the client is either going to invest in overseas market or is planning to open a company in overseas market, and we are going to advise him regarding it, the main factors that we should keep in our mind is that we must have the necessary amount of experience, which the ACCA's Code of Ethics also taught us that the fundamental principle is professional competence and due care. What do we mean by professional competence and due care? That we must update our knowledge to provide the most updated services. This is part of our job as well. So we as a firm should make sure that we must have the most updated knowledge using which we can advise the client. That's one thing. The second thing what we should consider is that because we have already advised several clients from that country or the overseas client, we should make sure that one of the key principles of ACCA's Code of Ethics is confidentiality. And what confidentiality states that when you're advising another client, you should make sure that the confidential or the trading secrets of one client should not be shared with the other. Otherwise you will breach the confidentiality and you will breach the ACCA's Code of Ethics. So two things that you must make sure here is that you must have the most updated set of skills and knowledge to advise the client, and you have to make sure that you do not breach the principle of confidentiality. Apart from that, you must make sure that if there is such thing or any ethical threat arises, you consider its impact on the assignment, and if you can mitigate the risk, you should go for the assignment. If not, then you should leave the assignment. So this part of ethics, or the points you should write in this part of ethics, you can easily find from the notes as well. However, majority of the times you will find that the ethical part of the question is of repetitive nature. So you can find such type of questions or such type of parts in the other questions as well. Then there is investment in J, I guess, to which the first paragraph relates. And what do I have to tell? Rep and CRO are UK resident companies which prepare the accounts for 31st March. Business profits generated in G are subject to 13% business tax in that country. There is no double taxation treaty between the UK and G. Residency of J Limited. I need to tell the relevance of the country of residency of J Limited, the amount of CT payable in UK and J in respect of its profit, the relief available to Rep if J Limited business were to make a trading loss. So guys, before I move on, I should make myself clear that what is happening here, I guess, is that one company is going to open another company in some other country, and they want us to tell them their tax implications, and there is no double taxation treaty. So if there is no double taxation treaty, obviously there will be tax, but there will be a DTR that will be available in the UK. And I can clearly see that UK tax is higher, so there will be double taxation relief at 19%. Now, then election to exempt the profits of J Limited's overseas permanent establishment from UK tax and list the implications. Now, this is a topic which you can find in the corporation tax part of my notes. That what normally happens is if you are a UK resident company, your worldwide profits are taxable in the country of UK, means they are subject to corporation tax. However, UK companies have a choice that they can make an election with HMRC that will exempt their overseas profits. They will then only be subject to UK profits, which will be taxed through corporation tax, but their overseas profits will not go taxed. So you have a choice. If you do not want to make election, all of your worldwide profits will be taxed in the UK. However, if you want to make that election, your profits will be exempted from UK's tax. However, in the country in which your companies will be operating, the tax will still be payable there, but the tax will not be payable in UK. So then it has asked me that what are its implications. What usually is the implication is that HMRC allows you to make this exemption or make this election, but if you make it, or it will be applicable on all of your subsidiaries. It cannot be made for one subsidiary that is overseas. That is one point. And the second is it will be irrevocable. Once you make the election, you will not have any choice that you can then go ahead and revoke the election. Then there is another advantage. If an overseas company makes loss, that loss cannot be set off against UK profits. However, in the absence of the exemption, because you are paying tax on that company's tax in UK, if the company suffers loss in overseas, that can be adjusted against UK's profit. But if you exempt the profits from tax, you will also will not be able to claim the losses against UK profits. So these are the disadvantages. I will read the question and see that as to how much relates to the scenario, and then will write my answer. Then the topic is controlled foreign company. You can find this topic as well in my notes, the CFC. There are certain conditions of that, and there are certain exemptions available to get rid of this CFC charge. Now, what CFC is, as I told you before, that if your company is a UK resident company, its worldwide profits will be subject to UK's corporation tax. However, if it is a non-UK resident company, then the profits earned by that company will not subject to UK's corporation tax. So what people normally do is they try to exploit this loophole. They open a company overseas and fulfill all the conditions that are necessary to declare that company as a non-resident. Once that company becomes non-resident company of the UK, then start to take dividends from that and thus start exploiting this second part. So the CFC rule has been established by HMRC to combat that. And if HMRC finds out that you have made the company non-resident only because you want to avoid corporation tax in the UK, the HMRC will then put a CFC charge, and the CFC charge means that HMRC will then put corporation tax charge on the profits on that company. So you were trying to avoid corporation tax. If HMRC finds out, they're gonna charge you the corporation tax. So that is what CFC for. So let's get back to the question. I can confirm that a CFC charge will not arise if J Limited is resident in G. However, I want to provide Lamar with an explanation, the purpose of the CFC rules and the charge which can be levied under them. So I've told you the purpose, but we will read the question, and if there is anything else that needs to be explained, we will explain it. So now we can move on to the scenario. You have always seen that before reading the scenario, I always try to make sense of something as to what the question is being asked about, so that I can recall what are the topics that are being tested in this question. I want to revise the knowledge that I must need to pass a score, uh, or to score a pass. Sorry. Now let's start reading the question. If anybody any questions, they can please put it in the question section. When Sayyid Raza has asked that what do I mean by to make an election. Make an election means informing the authority, informing the HMRC. You have to fill some sort of a form and then submit it to them. Election means sort of an agreement. So I have to make an agreement with HMRC that from now onwards none of my overseas companies will subject to UK corporation tax. Election is sort of an agreement for which you have to fulfill some of the documentation and submit to the authority. I hope, Sayed, I have answered your question. Now let's start reading the question. Your manager has received an email from Lamar. Lamar is the managing director and majority shareholder in Rep Limited. That's fine. Lamar and Rep Limited are clients of your firm. That's fine. Your manager has forwarded the email to you together with an email detailing the work you're required to do. Okay. Potential investment in J Limited. We are in discussion with the manager of CRO Limited regarding the establishment of a new company, J Limited. If it proceeds, J Limited will commence on trading from 1st April 2022 and carry on its business activities in the country of G, where it will manufacture computer components. So I was right that they are, thinking of establishing a company overseas. Okay. CRO is proposing that Rep Limited would own 30% of the ordinary share capital of J Limited, with CRO Limited owning the remaining 70%. Okay, so Lamar's company will jointly own this company, with Lamar owning the lesser amount, and majority of the shareholding will be owned by the other company, that is CRO. Because Rep is Lamar's company, so obviously indirectly Lamar's is owning 30% of the new company. However, we regard this potential investment as somewhat risky, such that if we decide to proceed, we may prefer to just own 20% of the J rather than 30%. That's fine. So I guess Lamar is unsure whether to go for 20 or 30. J Limited is expected to be profitable in the year ending 31st March 2023. However, there's a possibility that it will be making loss in either that year or in future years. Now, whenever examiner tries to tell you that client is unsure what will happen or which option he chooses, he is give a hint, guys, that you should talk about both sides of the picture. That is, you have to tell in the requirement what will happen if Lamar owns 30% of the new company, what will happen if he owns 20%. And you also have to tell what will be the tax implications if there will be profit, and what will happen if there will be a loss. So the examiner wants to tell you about both sides of the argument. Now, always remember that if the situation is unclear or unsure, he is giving you a hint. Please do pick that hint to score good marks. Now, J Limited's tax adjusted trading profit for the year ending 31st March 2023 is budgeted to be 135,000, all of which will relate to its activities in Garia. J Limited will have no other source of taxable income and will not make any chargeable gains during this year. That's fine. So I now have a figure that if the company will be profitable, the profits will be budgeted to be 135%. If there will be no figure about the losses, I will just discuss the implications of the losses. That is how you have to work out. If the figure is given, you will do the calculations. If the figure is not given, you will just discuss the implications verbally. Now, we have not been involved in a joint venture like this before, and we have no experience of carrying on a business outside the UK. We would appreciate your advice on the following three extracts from the documents provided to us by CRO Limited. Okay. It is yet to be determined whether J Limited will resident in the UK or Garia. If J Limited is resident in the UK, it will be considered to be carrying on its business through a permanent establishment in G. So, guys, obviously, it has now told me that they are in the process of deciding. So, I have to tell about both. Whether if what will happen if J Limited will be resident in the UK, it is pretty easy. That although the company is situated or incorporated somewhere else in the country of Garia, but because it is a UK resident company, it has to pay tax in Garia and in UK. However, the double taxation relief will be available. Obviously, if the company is uh, incorporated in Garia, then it will become a non-resident company, and there will be no tax. There will be no profits that will subject to UK corporation tax. If J Limited is resident in the UK, it will be considered to be carrying through a permanent establishment. That's fine. If J Limited is resident in the UK, will consider making an election to exempt its overseas trading profit. We have already discussed a little bit about the overseas action of exemption. Number three, we have been advised that if J Limited is resident in Garia, this will not result in a charge under the CFC. That's fine. So I just have to explain him what are the implications. And let's quickly kick out this part first because it just required the uh, explanation of CFC rules, and that we have discussed already. That because non-UK resident companies do not have to pay the tax in UK, the people try to exploit this rule, and that is why HMRC has introduced CFC charge. If HMRC catches any company that is owned by at least 25% or more by a UK company, only then CFC charge will be applicable. So if a company owns any company overseas, but the amount of ownership is less than 25%, there'll be no CFC charge. So I've already explained the CFC charge, so I've done at least this third point of the requirement. Now, purchase of investment property. We are considering the purchase by Rep Limited of a new unused commercial building for 200,000 plus 20% value added tax. Okay, Rep would then grant 20-year lease of this building to a retailer. Will Rep be able to recover the proposed charged VAT by the vendor on the sale of this building? So guys, for that we have to visit our notes, and there is a table I have put there for VAT. So if you go into the VAT folder, VAT chapter, on the third page almost, or the fourth page of the notes, you'll find this table regarding land and building. If you buy the new commercial land and building, means it is either uh, altogether new or less than 3 years old, it is a standard rated thing by default, which means whoever is selling you, he'll gonna charge you the output VAT and you have to suffer input VAT. Now, if you sell it before 3 years, obviously it is a standard rated item and you have to charge VAT as well to whoever you are selling. But if you are rather selling, giving it on a lease, then it depends whether the lease is less than 21 years. If yes, then it will be an exempt supply. If no, if it is more than 20 years, then it will be zero rated supply. You know that on zero rated supply there is a VAT that is being charged, but it is 0%. However, on exempt things you cannot charge VAT. So do remember that if the company buy that, the company has bought that building, but the company is going to give it on a lease of less than 20 years, it will be making an exempt supply. So guys, you tell me, if the company is making an exempt supply, will it be able to recover input VAT? That was the question in the in the exam. You tell me, will it answer me in yes or no? Will they be able to recover input VAT because they are making an exempt supply? Obviously not. So the answer to its question, Lamar's question, is no. And we will tell him, because he's a layman, we will tell him that by providing a lease of less than 20 years, you'll be making an exempt supply, and therefore you will not be able to recover input VAT. However, there is an option by which he can charge VAT if he opt to tax, which we all also there is another name for that called waiving of the exemption. You can request HMRC that you do not want an exemption. They should charge your they should waive off your exemption. Now guys, we have to understand that why one wants to waive off their exemption. Reason is, if I will be allowed to charge output VAT to someone, it will also allow me to recover my input VAT out of that output VAT. For example, I have bought something from Mr. A. Mr. A charged me Mr. A charged me the output VAT, and I have suffered it as an input VAT. Now, if I am reselling the same item to someone else and I have not been allowed to charge that person the VAT, it means I have to suffer the VAT myself. However, if HMRC allows me on reselling that item that I can charge the VAT as well to that person to whom I am selling, it will help me to recover the input VAT that I have suffered. What will happen? I will charge that person the output VAT. Whatever the money I will get in the form of output VAT, I will first deduct my input VAT from that, and the remaining I will submit it to HMRC. Okay, so that is why people are usually concerned that will they be able to recover the VAT. So guys, I have already told you, if he gave him the building as it is on less than 21 years lease without opting to tax, he will not be able to recover the input VAT. However, if he opt to tax, then he can charge the VAT. However, we then have to explain further implications to the client because he's a layman. We have to tell him that if you opt to tax, your commercial building will become a standard supply, and any tenant that will reside in that building or use that building, you have to charge them VAT or VAT with your rental payments. So if the tenants are VAT registered, they'll not have any issue whether you charge them the VAT or not. However, if the tenants are end consumers and not VAT registered people, then it will increase their cost significantly by 20%. That is one disadvantage of opting to tax. Another condition that is attached to opting to tax is that initially you have the 6 months period, even after opting to tax, that you have the option that you can take your decision back and tell HMRC that you first decided that you wanted to opt to tax, but you have now changed your decision and you want your building to be exempt. So you have 6 months of cooling off period, you can say, in which you can change your decision. But after that, the election or the agreement is irrevocable for the next 20 years. So these are a few points which you need to explain it to the client. The first is that the supply will become exempt, so they will not be able to recover input VAT. The second, that they have the option if they opt to tax. And then you tell them the implications of opting to tax, that they have to charge the rental VAT to their tenants on their rentals. It has a cooling off period of 6 months, but then cannot be revoked for 20 years. Okay, so these are the things. And there is an advantage. However, if they opt to tax, and whenever they sell the building to someone else after 20 years or after the lease period is over, they will then also have the option to charge the VAT on the sale of the building as well. So these are the advantages. So I have firstly answered the smaller part, that was part C. So let's get back to our question. This is the purchase of investment property, and you can clearly see this is C, requirement number C. So I've answered that, and I have answered the third part of requirement B, and A we have answered already. Now, moving back, let's talk about the last requirement, which I believe relates to the IHT. I established a discretionary trust for the benefit of my nieces and nephew. I guess it is Lamar. On 1st November 2021, I am planning to give 20,000 of my shares in Rep Limited to this trust. After I have made the gift, I will still own 60,000 shares of the company. You have already advised me that these shares are not relevant business property for the BPR. Okay, that's fine. So we do not have to consider BPR due to the investment activities of Rep Limited. Accordingly, I am aware that the gift of 1st November 2020 may result in IHT liability. If I decide to make a gift, I will pay the any IHT due. Okay, that's fine. So he has made this gifts in the past, a gift of cash to trustees on 1st August 11, then on February 17 a pet, then in May 17 additional cash to trustees, and then in June 2021 cash to sister. So guys, we can clearly see that there are two pets and two CLTs in those past transfer or past gifts. I only want to ask you one question. When do I have, when I check the past gifts or past transfers or the previous gift or previous transfers for the availability of nil red band, do I only have to consider if the person is alive? Do I only have to consider the CLTs or PET or both for the availability of NRB? Which transfer do I need to check? Answer me in the question section, please. CLTs, PET, or both if the person is alive. Come on, guys, I need more answers, please. Guys, the correct answer is that if the person is alive, only CLTs. Why? Because the PET will not be taxed until the person die. And obviously, the NRB is only applicable on the transfers that are being subject to IHT. For PET, we own what happens is if the individual transfers something to individual, we locked its value and we wait for the person's death or the donor's death. If the donor is alive, it means the pets are not being taxed right now. If the pets are not being taxed right now, it is obvious that they will not be using any NRB as well. As far as the CLTs are concerned, it doesn't matter whether the person is alive or has died, the CLTs will always be subject to IHT. That is why whenever there is a CLT, it must have consumed NRB. So, do tell me another thing. When I look at the previous transfers, how many years should I consider? How many years I should consider for checking the availability of nil rate band by looking at the previous transfers? Yes, that's right, 7 years. So from the date of transfer, that is November 2021, if I go back 7 years, it will be, I guess, 2014. So guys, do tell me that this 2011 transfer is a CLT because this has been made to trust. Shall I consider it or will it not be considered? Yes or no? No. Why? Because this is more than 7 years old. Yes. Thank you, guys. You're right. We will not consider that because it is more than 7 years old. So that is why we will not consider this transfer. Then there is only one CLT left in the last 7 years that I have to consider that might have consumed or must have consumed its NRB, and that is 170,000 that has been made on May 2017. Now, guys, when I have to deduct the amount from the NRB, which amount shall I deduct? 170 or shall I first deduct the annual exemptions from the 170? 170 itself or less annual exemption? Guys, do remember that if the question has not mentioned that the values below are transfer values or TVs, you will always have to consider that you have to deduct the annual exemption yourself. This question has not mentioned that below are the transfer values, which means if they are not the transfer values or the TVs, then the annual exemption has not been deducted. Now, my next question is, I know that now I have to deduct the annual exemption. How much annual exemption shall I deduct? 3,000 or 6,000? 3,000 or 6,000? So all of the students who are saying 6,000, always remember that if there is a transfer immediately in the previous tax year, the previous taxing annual exemption will not be available. In that you can clearly see that in February 2017, there is another transfer which must have used the annual exemption of 1617. Then May 17 transfer falls into tax year 1718, which means this transfer will only have one annual exemption available, Why I am stopping and emphasizing on these points? Because all of the students who have answered Rasha, Sayed, and Fahim 6,000, the reason is majority of the question which we might have practiced, when we look at the solution, they have 6,000 being deducted already. So we, in our rhythm, may tend to ignore that, oh, this question has a trick in that. It does not includes 6,000 complete annual exemption to be deducted. Rather, only 3,000 annual exemption is to be deducted in this question. So look for these tricks. Do remember that first of all, the word TV or the transfer values is mentioned. Then secondly, before deducting 6,000, in your rhythm, have a quick look that is there any transfer that has been made in immediate previous tax years. That will help you to avoid this mistake. Now, because students bombard me with the questions, oh sir, sorry, we might have missed, we don't believe that we can consider such small points in the exam. Do you have any trick for that? Yes. Whenever you make a mistake, always think yourself as to how you can avoid it. For example, I have figured out, okay, fine, I have to look for the word transfer value to figure out, do I have to deduct the annual exemption or not. Then to check whether 6,000 or 3,000, just need to check that is there an immediate transfer before. So these are the two tricks that I have told you, with the help of which you should avoid this mistake. Now guys, the amount of transfer is 170. If I'll deduct 167, how much nil rate band will left for this amount, or for this transfer? Can you tell me the amount in the question section, please? 170,000 is the amount of transfer, less 3,000 annual exemption is 167. So 325 minus 167, let's quickly check. 325 minus 167 equals to 158,000. So do remember that we have figured out before the other calculations that the nil rate band that will be available to this transfer is 158. Now guys, in IHT there are two types of transfers. One whose value remains static. For example, if I buy one glass and the price of glass is £10 per glass, if I buy 5 glass, the shopkeeper either may give me a discount of 1 or 2%, or if there is no discount, the price of 5 glass will be £50. But there are some assets whose value is different if you buy a single unit, and its value will become change if you buy multiple units. It can be property, it can be agricultural land, it can be shares. There are few examples. So HMRC has said, if you have transferred assets of such nature whose value changes as its amount increases or decreases, for that you cannot calculate your transfer value or the value of the gift transferred normally. For that you have to use a technique, and that technique is mentioned in my notes. So I will take you to my notes. The first chapter is IHT, and the one of the very first topics are transfer of value. Transfer of value means that the value of a single unit is different and the value of multiple unit is different. So if you have the ownership of multiple units, and out of that you disposes of or transfers some units to someone, you cannot take its value as per the unit value. For example, if somebody has a set of antique chairs and one chair is worth 10,000, two for 14, three for 25, and four for 38. If they transfer one chair to someone, you cannot take the value of 10,000. Why? Because the value is not static per unit. So what is the other technique? HMRC says that you have to take the total wealth of the donor before the transfer and then match it with the total wealth of the donor after the transfer, which means that the person had 4 chairs in total before, who and their worth was 38,000. Then he was left with 3 chairs after transferring one. So then his wealth was 25,000. So the difference in the decrease in his or her wealth is 13,000. So you will gonna take the decrease in wealth as transfer value, not the per unit value. So here is the case in our question. The same is the case in our question, that these are the shares of public limited company or maybe a private limited company, but the value of the share is changing with, for example, if he has 60,000 shares, the value will be different. If he has 80% shares, the value is different. So let's see what are the values. That can be seen in part D. Lamar currently owns 80% of the ordinary share capital, and we have seen that he has transferred 20% of the amount of shares. Why? Because when he was at 60,000, he had 60% holding of the company. So obviously, if he has given 20,000 shares, he must have before 80% holding of the company. So before, each share Lamar owned used to be £24 per share when he was shareholder of 75% or more, but now he's in the category of 51% to 74%. So now his per share value is £17. So what do we have to do? We have to calculate that because of this difference, how much value or how much wealth has been decreased by Lamar or of Lamar. So let's use spreadsheet, guys, and then calculate the decrease in the value of Lamar, so that we can kick out this D part first, and then we can focus on those lengthier parts of part A, 1 and 2. We have already done other parts. So I will use this as a description, and these two I will use as values. Now, first of all, we have to calculate transfer value. So wealth before transfer and wealth after transfer. So we will write before transfer here, and we will write that he used to have 80,000 shares and each share was worth £24. After transfer, there are like 60,000 shares he's left with, and each share was worth £17. Let's confirm those figures from the question first. Yes, 24 and 17. Now we can apply a formula here, equals to 80,000 times 24 and 60,000 times 17. We will write less here to tell examiner that we have deducted both of these figures. So this minus this, whatever the decrease, that will be transfer value. So this is our TV. Now we have the TV. So what we can do is we can deduct annual exemptions from that. But we first have to check and make sure that there are no transfer made in the same year, just to make sure that we have the complete annual exemptions left. So let's quickly go and check the details of his transfer. So guys, he has made one transfer of 170,000 of sorry, this is the transfer 45,000, and that has been made in 1st July 2021. So guys, you tell me, this transfer or this pet would have used the annual exemption, yes or no? More answers, guys. This pet would have used the annual exemption. Yes, because it is way more than 6,000. This transfer is for 45,000, and there was no transfer in 2020. So this transfer must have used the 6,000 of annual exemptions, and unfortunately, no annual exemption might have left for this transfer. And the reason is this transfer he's planning is on 1st November 2021, and this transfer he has already made on 1st July 2021. So now that transfer was before the gift of shares. So it must have used the annual exemptions, which means that I do not have any annual exemption left. So I will tell the examiner by stating that it is already used. I have not skipped that. Now, this is my chargeable amount. Another word that you might came across in the question is gross chargeable amount of the following gift is this. Guys, if you have came across the word gross chargeable amount or the GCAs, do remember that out of GCAs, it is obvious that the annual exemption has already been deducted. You don't have to deduct now to check the calculation of NRB. Now, let's deduct our NRB out of that. So less NRB, and we have already calculated that it is 325,000 less 158,000. Sorry, not 158, 167,000 equals to 158,000. So let's put a formula here. 325,000 minus 167,000, it's 158. So this minus this will be the taxable amount. Now guys, as it is a pet, as it is a CLT, we have to check that who will be paying tax. If Lamar is going to bear the tax, then the IHT will be at 25%. If trustees are going to bear the tax, then the IHT will be at 20%. So let's go back to the question. And it says, I will pay any IHT due, which means the percentage will be 25%. So IHT at the rate 25%, this multiply by 25%. Because I have applied formulas throughout, if there is any figure I might have only calculated, for example, let's say that the correct answer is the correct figure here to put was 1920, but let's say I have wrongly would have put 1.8 million, my complete answer would have been wrong. By just correcting one figure, my complete answer would have been corrected as well. And there you can see. So that is the advantage of putting formula. If you have realized later on that you have made a mistake, what you will do is you will only correct one figure and all of the remaining answer will get adjusted automatically. So we are done with this part C. We can now go back and solve the remaining parts. If anybody has any question, they can post it in the question section. One student has asked, is there any WhatsApp group? Unfortunately, there isn't. Okay, guys. So let's move back to the remaining parts of the question. Now, 1 and 2 have still left to be answered. Residency of J Limited. Explain the relevance of the country of J Limited in relation to the amount of corporation tax payable in the UK and Garia in respect of its profits. So, okay, guys, the relief available to Rep Limited if J's business in Garia were to make a trading loss. So, I have to now answer both sides of the argument that if the company will be resident in the UK, what will be the tax implications? If not, then what will be the tax implications? If the company will be resident in the UK, then obviously the company has to pay the tax in Garia and then has to pay the tax in UK as well, but the DTR will be available. But because The numbers were available. I have to perform the calculations. And I remember that the amount of profit was, I guess, 135,000. Let me quickly confirm. Yes, the budgeted profit is 135,000. So let's get back and see resident in UK. Profits are 135,000. CT on the profits would have been 19%. However, DTR would have been available. Less DTR. DTR at 13%, I guess. Let me quickly confirm what was the rate of tax in G. Yes, 13% is the rate. So equals to this times 13%. So CT payable would have been this. If the country is resident in the UK, you have to also write explanation. If the country is, if the company is resident in the UK, it will have to pay corporation tax. However, DTR will be available. And if in the case of loss, because we do not have the figure, so we can just explain. So you will say that if the company will make a loss, then because the company is resident in the UK, it is allowed to adjust those losses against the UK's taxable trading profits of parent company. That is the situation if the company is resident in the UK. I have told both about profit and loss. Now let's discuss if the company is resident in the country of G. Obviously, if the company is resident in the country of G, then there will be no there will be no corporation tax payable in the UK. The only 13% tax will be payable in the country of G. This is an advantage. The disadvantage is no losses will always also be allowed to offset against the UK profits. So I have now discussed about both situations, if the company is resident in the UK or not, and in profit or loss. So I've explained four situations, that if the company is resident in the UK or overseas, the profit perspective, and then the loss perspective. So I've explained four situations. Now I have done with part B1, that is this residency. Then election to exempt the profits I have already explained. And there was another thing which I have to mention, that they were also unsure as to how to own the company. What will be the structure of the company as far as the ownership is concerned? Whether Rep Limited will own 80% of the company, or whether Rep Limited will going to own 20% of the company. Now, will it make any difference? Yes, it does. If Rep is going to own 30% with CRO, the J Limited, the J Limited will become a consortium company. What is a consortium company? You can find this in my notes in corporation tax section. Consortium companies of such company in which two or more companies have the ownership, but no company has the ownership of 75% or more, and no company has ownership of less than 5%. So this is the two criteria. None of the companies should have less than 5% ownership or more than 74% of the ownership. If this is the case, then this company will become consortium company. Now, what do we mean by a consortium company? Or rather, what are the tax implications of consortium company? The tax implications are that because the companies have multiple owners, if the company makes loss, the loss will not be given or surrendered to one company. The problem is, guys, if your subsidiary will earn or make a loss, everybody will be welcome to take that loss. Why? Because it will save their tax. However, if the company will make a profit, everybody will be reluctant to take that profit because it will increase their tax liability. So in consortium company, if the company makes profit, the profit will be distributed according to the percentage of ownership everybody has. And if the company makes a loss, the loss will be surrendered to everyone according to the percentage they own in the company. However, if anybody owns more than 74%, that is 75%, then the company that owns 75%, they will make that company their group member. And by making them group member, although they just own it 75% or more, but they will claim its 100% loss. Why? Because it will become a loss relief group member of the company. So in the second structure, in which Lamar is thinking to own, sorry, Rep is thinking to own only owning 20% and giving 80% to CRO, do remember that if Lamar's company own lesser ownership, that is 20% rather than 30, then J Limited will become a loss relief group member of CRO, and Lamar will not be able to claim any loss in case of if the company makes losses. So this is the difference between the structure. What you should do is you should make two headings in the answer. If Rep Limited owns 30%, and the second heading should be if Rep Limited owns 20%. In 30%, you will explain what the consortium company is, and in 20%, you will mention that it will become gain loss relief group member of the other company. Now, guys, with that, we have answered all the requirements of this question. I hope that I have explained everything quite clearly so that it would have helped you to understand these crucial topics. And I also tried to help you to teach you the technique and with which you should approach the question number one. If you have any more questions, please put it in the question section. Sayed Raza has asked that, sir, whenever we start a new question, shall we need to change the spreadsheet? Sayed, it's not that the case. What happens is, with one question, you have only one spreadsheet available. Whenever you change a question, new spreadsheet will be available. Your question should rather be that, shall we use new spreadsheet for every part of the question? And the answer is no. You can use the same spreadsheet for all parts by just mentioning for which part are you performing the calculations, and you should use the same word processor sheet for the same question by just mentioning the part name at the top. So you are not even have the option to use new sheet for each part, but for new question, automatically you'll have the new sheet. I hope I have answered the question. I will explain it further because we will also be solving the next question on the practice platform. Saeed Raza, because I have mentioned the Saeed Raza is asking that can I provide the solutions of these questions? Saeed, because I have mentioned the attempts of the questions, you can easily find their answers from past exam paper by downloading the attempt, or you can use the Kaplan's kit. The questions are available in that, and you can find the answers from there. Any more questions? Okay. Is it okay to answer the worded part in spreadsheet as well? Yes, Rakesh, I have answered this question yesterday as well, that it is perfectly fine if you are more comfortable with spreadsheet and you think that there are few parts and you do not want to use word processor. That is perfectly fine if you use spreadsheet for everything or word processor for everything. If you are easy to perform calculations in word processor, that is fine too. All the examiner is concerned with the answer is he does not specify that you needs to use both, but I will recommend that you should do this only for question number one. Why? Because it has 4 professional marks, and he will be looking that whether you have the knowledge to use the functionality of both. So I'll recommend to do this even if you not like, just for question number one, but for remaining questions it's entirely your choice. Yes, Sayed Raza has asked, sir, when we'll attempt a question and we move on to the next question, will our answer automatically get saved? Yes, and even if you get disconnected, the spreadsheet is saving your answers along with your attempting the question. So you do not have to save, and even you do not have the option to save. The software automatically saves the things themselves. Okay, guys, let's take a 10-minute break and we will come back after the 10-minute break. Or rather, we will take a 15-minute break today because we have stopped after almost an hour. So we'll take a 15-minute break today and then we'll be back and we'll start our next 35 mark question. So students, let's resume. And yes, few of students have joined late. Yes, we were on break, guys. Okay, one more thing I would like to emphasize on, that there is a article of the Examiner, a extremely good article, and it's called ATX Read the Mind of the Marker. ACCA used to conduct the sessions as well, called Read the Mind of the Marker. They are still available on YouTube as well, or available on the ACCA's website as well. I used to conduct those sessions as well, which were named after the same theme, that is Read the Mind of the Marker. In that article, the examiner has tried to explain that what is a good answer, what is a bad answer, and what do you lose by writing a bad answer, and what do you gain by writing a good answer. It is a very good article, and the question in which the examiner has solved is the same question that I have solved with you. That is Lamar. So please uh, do have a good look at this article. It can easily be found in the ATX section of the ATX section of the ACCA's website, or you can directly write it on Google, that ATX article, Read the Mind of the Marker. It is a very good article. Please, please, please do read that. It includes 2 to 3 answers in which examiner has clearly told what is a good answer, what is a bad answer. For example, this is the standard solution. After that, then that's a candidate one answer, and examiner is telling you how many marks he is actually getting. And in the note section you can read that what examiner thinks are the mistakes. These are the notes in which you can clearly see that what are the mistakes. Then there is a candidate 2 answer who has scored 22 out of 35. The first one has scored 27.5 out of 35. This is his answer, and these are the notes in which the examining team has told you where were the mistakes. So this is a very good article. It is on the same question that we have just solved. Uh, Please do give it a good look and read it carefully. Okay, guys. So moving back, let's move on to our next question. The next question I have selected today is Grand Limited. It is for September 18 attempt. It is also available on ACCA's CB practice platform as a practice exam 1, and it is the first question of that. So as you can see from the requirements that it is a 35 mark question. So let's quickly click on the requirements, and obviously as we have know by now that this will be merely the marking scheme. So there you can see 8 marks for the first requirement, that is offer A in respect of sale of company's shares, offer B in respect of sale of company's trade and assets. This is for 11 marks. Then the third is part relates to VAT. Then it's tax evasion versus avoidance. This is definitely the ethics part, and it is for 5 marks as well. And then we have 4 professional marks as well available. So moving back, this schedule would definitely had the requirements in detail. So I will skip the first 2 requirements. This is rather the schedule. This does not includes the requirement in detail. Let's click on this extract of email from manager. This includes the details, for example, Grand Limited group of companies, offer B of offer 1, offer A, offer B, and then we have this part, tax evasion and avoidance. And as you know that my policy is always to kick out the easy part first. So I will go after the tax evasion and avoidance part first. B and his daughter, who is tax expert in the field of capital allowances, have drawn up a plan which they claim will enable the company to claim a tax reduction of 180% of the cost of new machinery. The plan is complicated and it involves the creation of new wholly owned subsidiary and the series of contracts involving the leasing and subleasing of the machinery between the two companies. So guys, before I move on, I would like to stop here and ask you that if anybody buys any new plant and machinery, what is the maximum percentage of tax deduction he or she can achieve? Tell me in the question section. Obviously 100%, that is they cannot claim they can claim AIA allowance. So the max they can claim is 100%. So if anybody is claiming more than 100% and performing any such trick which is just only to claim more tax deduction, what do you think? Will it be legal or will it be illegal? Obviously illegal. Why? Because if it would have been for genuine commercial reasons, then we might have thought that it is illegal. But as it is solely for the purpose of higher tax deduction, this will be illegal. Now, let's further read the question. I have not looked at the plan in detail because even if it would appear to have the intended effect, I am sure it would fall within the general anti-abusive rule GAAR. Please prepare notes which distinguish between tax evasion and tax avoidance and state the purpose in of the GAAR and explain why the GAAR is likely to apply to this particular plan. So guys, first of all, tax evasion versus tax avoidance. So I will ask you one in one word and then I will explain it. Tax evasion is legal or illegal? Tell me in the question section. Okay. And what about tax avoidance? Is it legal? Yes, avoidance is legal. Avoidance means using the tax rules to minimize your tax liability, which is legal. However, tax evasion means reducing your tax liability through illegal practices. Okay, so this was the first thing, the difference between the tax evasion and the tax avoidance. Now, what is GAAR? Let's quickly visit the section, ethics section of my notes to see what GAAR is. In the very end, you will find GAAR. So, GAAR means General Anti-Abusive Rules, and they are if HMRC figures out any trick which is used illegally to gain any tax advantage which is not normally available. Okay, so what we'll explain, we'll say that general anti-abusive rule applies to arrangement which are considered to be abusive, and abusive means that through them illegally tax advantage can be obtained more than it can usually be obtained. Number one. So guys, you tell me, do you think that the way or the idea or the trick that they are going to develop, will it fall into GAAR scheme? Yes, it will be considered abusive and it will be fall into GAAR, and HMRC can penalize them and the penalty of 60% can be charged of the tax advantage gained through GAAR. So if you would have known this, you could have scored easily 5 marks. And then your next target could have been to score 4 professional marks, out of only 2 relates to layout and 2 is for the quality of the answer. Now, let's move back to the question. Let's talk about the other requirements. Grand Limited has two wholly owned subsidiaries, C and S Limited, and also shares in a number of other companies. All of the group companies are UK resident companies, which prepare accounts 31st March each year. All supplies made by the group are subject to VAT at the standard rate. S Limited has been a member of G Limited for many years. Okay. Sale of C Limited. So the company, the main group, Grant Limited, is going to sell one of the company they own called C Limited. Grant Limited purchased the whole of the ordinary share capital of C Limited for 800,000 on 1st November 2013. The value of the C has fallen and the company is to be sold on 1st December. So it means that the company is going to sell it on in loss. Guys, if you have a company which you owned 100% and you are going to sell it in a profit, is there any exemption available in corporation tax for that? If yes, please enter the name of that exemption in the answer section or in the question section. Any exemption that applies if you sell your company at a profit. Belgian, you're absolutely right. The name of the exemption is SSE, Substantial Shareholding Exemption. It is available if you sell the shares of the company at a profit. However, there is a criteria which obviously applies to 100% wholly owned subsidiaries. The criteria is, let me take you to my notes where we have the definition of SSE. The criteria is that if a company owns the other company 10% or more, and they have owned its shares for at least 12 months in the last 6 years, at any time their combined holding is 10% or more, then if they sell the share of such company, the gain on that will be exempt. There will be no corporation tax on the gain. You know that the companies do not pay capital gains tax on their gain, they rather pay corporation tax on their gains as well. There used to be a condition that the company must be trading condition that has been removed in the Finance Act 20. First thing. The second thing is it used to be 12 months out of previous 24 months. That is 2 years. That has been extended to 6 years now. So these are the two changes in the Finance Act. So the reason I have chosen this topic is also to tell you that there are certain changes in the SSE. Now, let's move back to the question. But here the case is opposite. Rather than selling at a profit, the company is going to sell the shares at loss. So guys, my question is, can we claim this loss? Can we claim this loss? More answers, please. The answer is no. Reason is HMRC has taken a position that we have given you a certain advantage as a company that if you sell the shares at a profit, we are not going to take any tax from you. On contrary, if you're going to sell it at a loss, we will not be providing you any relief as well. Is it okay, guys? Have you understood what I've tried to say? Okay. Now, moving on. As far as the first part is concerned, you should know that if the company is going to if the company is going to sell the shares of C Limited at a loss, it will not be able to claim that loss. Why? Because of the availability of the SSE, and that's what you will be writing in the answer as well. Now, let's see what is happening. Do remember that we have bought it for 800,000. Offer A. The purchaser will pay 730,000 for whole of the ordinary share capital. The amount will be reduced by any tax liabilities paid by C Limited arising as a result of the company being sold. So as I already told you that the 70,000 loss, we will not be able to claim that due to the availability of the SSE. Now, let's talk about the second offer. In respect of the sale of the company's trade and asset, the purchaser will pay 695,000 for the trade and assets of Kolka Limited. Another offer that the company has received, that rather than selling us the share, just sell us the trade and the assets of the company. We do not need your name, C Limited. Just provide us the asset and we will run the business under our own name. So they are only going to buy the assets. So guys, if the assets are going to be at sold at a gain, what do you think? Will the company needs to pay corporation tax on the chargeable gain? Yes or no? Yes. In that option, do remember that the company may have to pay corporation tax on the chargeable gain. So, okay, we have two buildings, or a buy building, a dual building, items of some machinery, and some net current assets. That's fine. There is further information in respect of these assets that is attached in the schedule from Bryce, I guess. This is the schedule from Bryce. Okay, we'll look into it later on. The value of the C's goodwill is negligible and shouldn't be ignored for the purposes of this work. That's fine. Please prepare a memo. So you should remember that you need to you need to learn the format of the memo, and that is, you will first write name of the client, that is Grand Limited Group, then subject, and then the subject is sale of C Limited, prepared by, always whatever you are in the question. In this question we are tax senior. Date should be always your exam date. Now, moving on, let's read the requirement in detail. What do we have to write in offer A? An explanation of whether or not tax relief will be available in respect of the capital loss arising on the sale of these shares. I've already told you the loss will not be available because of the availability of the SSE. An explanation of the tax implications of C Limited leaving the Grand Limited Group list still owning A building. This explanation should include any calculations. Okay, it is a hint that this explanation must have any calculations in that. That is why the examiner is providing us that hint. A calculation of the expected post-tax proceeds. So we have to perform post-tax proceeds as well. We have the proceeds available, that is 730,000, I guess. Yes. All I have to check is if there is any tax, I will deduct it from 730 and we'll have the answer of after tax proceeds. What do we have to write in offer B? Value added tax. In respect of offer B, an explanation as to whether or not C Limited should charge VAT on the sale of the buildings and or its machinery. For that, I have to check about what is the status of buildings by looking at this schedule. So let's go and check the schedule. Kolka Limited details of assets. C Limited using both the Orabai building and a dual building in its trade. Fine. As we are now disposing of the company, obviously we are selling its assets together as well, either through share or through separately. Date of purchase February 14, April 19. Purchase cost 320 and 255. This will be helpful when we'll be calculating chargeable gain for the offer B. So I will note that. Option to tax? No. So obviously, as the company has not made option to tax, it means the buildings currently are exempt. So guys, you tell me, by, let's get back to the requirement, what it was asking. In this, an explanation as whether or not C Limited can charge VAT on sale of these buildings. Now you tell me, we haven't opted for tax, so can we charge VAT when we sell these buildings? No, we cannot charge VAT if we have opted out of tax, because it is an exempt supply right now. However, if we would have opted to tax, then it would have become the standard rated supply, and then we should have charged VAT. Now, that's what we have to check, Rukesh, that if the buildings were within 3 years, then we have to charge VAT. If the buildings are older than 3 years, then not, obviously. So for A building, I can see that we have bought it in April 2019. So it is within 3 years. And if we have bought that building new, not second handed or as an old building, then we will be charging VAT for on A. For O, as it is an old building, that is definitely will not be charging VAT on that. Now, let's move on the notes. On December 13, C Limited sold a machine for 74,000, resulting in a chargeable gain of 17,000. Okay. This gain was rolled over against the purchase of Orabai building. So guys, if we have rolled off or rolled over any gain against this Orabai building, obviously its cost would have been decreased with the value of gain. So what will be its base cost then? 320,000 minus this rollover gain, that is 303,000. So moving on, C Limited purchased the A building from S Limited for 255,000. It means this building has been purchased from some other group member. So now what happens when you purchase something from your group member? What happens is that if you have purchased anything from your group member, because you are a 75% gain group members, at that time of transfer, there will be no gain chargeable on the company that is selling the building, and there will be no stamp duty land tax on the company that is purchasing the building. HMRC is providing you this relief because you guys are group member. Now, if the company who has purchased the building remains in the group for 6 years, they will not have to pay any tax or stamp duty land tax if they leave the group after 6 years on this asset which they have taken from some other group member. However, if they leave the group within 6 years and they have bought an asset from any of the group member within those last 6 years, HMRC says that you now have to pay capital gains tax to us, which you haven't paid at that time and availed the advantage of being a group member. But that is the case if you leave the group after getting any asset from your group member within 6 years. Particularly if it is a building, obviously you would have saved the stamp duty land tax because stamp duty land tax is paid by the purchaser, whereas gain tax is paid by the seller. Now, you have saved both as a seller, gain tax, and as a purchaser, stamp duty land tax. HMRC says that if you have bought any building from your group member within 3 years before leaving the group, you not only have to return the capital gains tax, but you also have to submit the stamp duty land tax to us as well. So do remember that because we have recently taken this building from our group member, and now we are selling the C Limited, and we are selling this building as well along with C Limited. Grand Limited will not only have to pay degrouping charge, but will also have to pay the stamp duty land tax as well. Now, before I move on, I would like everybody to raise their hands if they have understood what I have explained till this point. Meanwhile, if you have any questions, you can paste here. You can also find degrouping charge as a topic into my notes in the corporation tax chapter. So we were selling the company in two ways. We were either selling it through shares or we were selling it through trade and assets. Either way, do remember that we must have to pay the stamp duty land tax back anyways. Now, the cost of the building is 255, and do remember that the cost of the next building is 320. Its market value at that time was 255, so obviously the value at which the company is going to pay the gain tax is 255. We will deduct that from today's market value to calculate the gain or loss. S Limited had purchased the A building, new and unused, for 340,000 on 1st January 2018. So guys, because we are selling this building now and it is within 3 years and it is a new building, new commercial building, it is still a standard rated supply, and we will be charging VAT to whoever we are selling this building. But Orebai building, it is more than 3 years, so obviously will not be charging VAT on that. Number three, all of the items in machinery are movable. The sale of the machinery will give rise to balancing charge on 12,100. Most of the items of the machinery worth less than their original cost. However, a small number of items particularly specialized such that their market value exceeds their original cost. Guys, you remember that you do not calculate capital gains on plant and machinery. Why? Because the reason being they are being sold at some price, or the reason you do not charge the capital gains on them, because whenever you bought a depreciable asset, HMRC has already given you capital allowances. So later on, if you sell that asset in loss, the loss is not claimable. However, if you sell that asset for a profit, the profit will subject to corporation tax. Balancing charge mean that we are selling this plant and machinery at a profit, which means there will be a 19% corporation tax on that as well. Now, that's it in the schedule. Let's quickly get back and calculate the capital gain in one by one of all the items that we are going to sell, so that we can calculate what are the after tax proceeds for offer A and offer B. These are the values which we can use as selling proceeds. So we will be using spreadsheet for both the offers, offer A and offer B. This is offer A. The money we are receiving is proceeds, that is 730,000 less tax. I haven't worked out what the tax will be, but whatever the tax will be, this sorry this minus this will be my after tax proceeds. Now let's write for offer B. I will have to write my proceeds that I can copy from the question. I'm gonna get 695 in total. So 695,000 less tax. I don't know at the moment, and this will be my after tax proceeds. I'll copy the formula as well. Yes. Now let's quickly calculate the tax now. CT payable one by one. So firstly, we have to take each asset one by one. So firstly, we have Orebai building. Its proceeds are so guys, its proceeds are 410,000 minus its cost. 410,000 are the proceeds. To check the cost, we have to check the schedule. It's 320,000 less 320,000. There I can apply the formula. 410 minus 320. 90,000 is the gain on that. Guys, do remember that when it comes to company, not only have to calculate the gain, but you also have to deduct the indexation allowance. Now, what is the indexation allowance? I have to stop and tell you. It is only available for the companies. Indexation is basically the amount of gain that you have earned due to the inflation over the years, and only for companies you can remove this part from the gain you have calculated. But do remember that it is now not available for the companies as well, and the gain has the indexation allowance has now been stopped or frozen on 1st December 2017. So it will not be available after that date. So let's see, where do we have the indexation allowances available? There it is. So we have to apply the indexation on this as well. It will be applicable from the date of purchase till date of sale or December 2017, guys. Answer me in the question section, please. Till date of sale or December 2017? Yes, thank you. December 2017 is the answer. So for Orebai, let's quickly check the year of Orebai's purchase. I have purchased that in February 14. So February 14 till December 17. This one, 0.094. So 320,000. Sorry, I have to also deduct rollover relief from that. Less. Or what we can do is we can deduct it from there and telling the examiner in the same line that we know that rollover relief of 17,000 will also decrease its cost, and we can update our formula here. It's 73,000. Oh, sorry, I might have done any mistake. Yes, the gain is 73,000. So less indexation. Let's quickly check what is the indexation. Indexation is normally on cost only. So it will be the cost is 303,000 times. Let's quickly copy it from there. 0.094. 303,000 multiply by 1094. 303,000 1094. This is the indexation. So indexation will be deducted from this amount. So this is my indexed gain. This was the gain before indexation. This was the indexation allowance. And this is the indexed gain. So we have calculated the gain for Orebai building. Let's take next building. It was a 12 building. Now, again, proceeds and cost. So let's visit schedule for the cost. It's 255 and extract for the, so it's in loss. Its proceeds are 230 whereas its cost is 255. So we will write 255,000 less 230,000 25,000 loss. We'll put a minus sign as it is in loss. Then any other asset left? Let's quickly check the schedule and the extract. Yes, items of machinery, they had the charge balancing charge on them and it was 12,100. So balancing charge on them. Charge was 12,100. Now guys, if I total all the assets, this is the indexed gain plus this loss plus this balancing charge. This is the total amount on which CT should be charged. So total gain CT at 19% will be 6007. Any question you guys have, you can put it in the question section. This will be the corporation tax that will be payable if we sell all the assets only. So I can go there in offer B and I can put this value. And my after tax proceeds will be this. However, if I choose offer A, as I am selling the shares, I only have to pay D grouping charge and nothing else. Now D grouping charge includes A building, which is being sold at a loss. Because of the SSE, the loss is not available. So the loss of this building will increase my loss. but the loss is still not available, so it cannot be deducted from these proceeds. The only thing that can be deducted from this proceeds is stamp duty land tax. So that I have to calculate myself. Stamp duty land tax is paid by the purchaser. So I have to check the value on the date they have purchased. It was 255,000. If you want to check that what is the rate of stamp duty land tax, click help tax tables, then click on tax tables, search for stamp duty land tax rates. This is the stamp duty on non-residential buildings. So the value of ours is 250, out of which 150 will be at 0% and 150 to 250, that is 100,000, will be at 2%. So we can go back into the spreadsheet and calculate stamp duty land tax. 150,000 at 0% and 100,000 at 2%. That is 2,000. See, the only thing that will be payable here will be 2,000. However, here it will have the answer that we have taken plus 2,000. So this way we have both the after tax proceeds. Guys, you tell me which option shall we use to sell this company? Shall we give only the shares or shall we sell the assets? Offer A or offer B? Tell me in the question section, please. Offer A versus offer B. The easiest solution to this is always look for that in which option the client is getting more after tax proceeds. The client is having more money. In which option do you think that the client is receiving more money? Option A or option B? Option A. Let me quickly go through with you guys my working. I have started with offer A and offer B. Then I have started writing the data from the question, that is proceeds. Then calculated the tax myself, that is gain on one by one on all three assets, or a buy building, a 12 building in machinery. One asset was in loss, two were in gain. Added both, then taken 19% and calculated the stamp duty land tax. And then deducted. Now guys, these are only the calculations, but you also need to explain it. And what will be the explanations? For example, in part A, you will be telling that the loss is not to be available to claim. Why? Because of the availability of the SSE. That is one point you will tell. And then you will tell why the SSE would have been available, because it has been the wholly owned subsidiary and has been owned more than 10% and for more than 12 months. This is the reason SSE would have been available, and that is why loss will not be claimable. Then you'll be telling that either way the degrouping charge will be available, and then you'll tell client what is the degrouping charge. It is a charge which will apply to the company when it leaves within 6 years after receiving an asset from their group member. Now you'll also tell them that if it leaves within 3 years and if it has bought a building, it also has to pay stamp duty land tax on that. So that is the case. Now for offer B, what you will explain is you'll explain that why you have taken the indexation allowances till December 17. Also, you will tell that why you have ignored few things like the net current assets. The net current assets are exempt from capital gains point of view, so you haven't taken them. You will also explain that the balancing charge will be subject to the corporation tax as well. And in the end, you will tell Grant Limited that if he sells the building or if he sells the company through shares, if the loss on any asset is received, it can also be surrendered to other gain group members. For example, they have suffered a loss on a building for 25,000. This loss could be surrendered to other gain group members. These are the additional points that you could have explained. Then for part B, it has asked you about the VAT thing. So I have told you that because one building has been bought within 3 years, so we have to charge the VAT on that. The other building is older than 3 years. That is why we will not charge the VAT. So guys, any question regarding this? Post it in the question section. I know it was a bit difficult question, but I will be dedicating 5 more minutes to your questions only. If you have any question, you can ask. Okay guys, let's take a 10 minutes break and then we will do another question today, which we were unable to do at the very first day, and the name of the question is Max. You can download that question from your handout section. So I'll see you after the break. Okay, guys, let's resume. And today's last question is Max, that I have selected from March June 18 attempt. So, as we normally do, let's quickly go through the requirements and then we will discuss about what the question is all about. In respect of the proposed gift of the office premises to Farah on 30th June 2021, advise whether or not capital gains tax relief will be available, and if so, to what extent. Okay, then advise Max of the maximum potential IHT liability and the circumstances in which this would arise otherwise. That's fine. So the one requirement deals to CGT gift relief. I have to tell Max, and then I have to tell Max about the IHT liability about the same gift as well. And this is some office premises that he's gifting to someone called Farah on 30th June 2021. Then requirement B, explain the effect of Max period of living overseas on his UK resident status for all relevant tax years and advise him of the CGT consequences of the sale of the warehouse in June 2021 or alternatively in June 2022. So obviously there would have been some difference if he would have sold it in June 21 as compared to June 2022. So this is a hint. I have to figure out what will be the difference in his tax implications. And also this part tests the topic called residency test of income tax and CGT. Now, no calculations are required for this part, so I will only be explaining for this part. Then we have explained whether or not business asset disposal relief BADR will be available on the sale of the machine and calculate the increase in max after tax proceeds if he sells the machine in June 2022 rather than in June 2021. So guys, obviously there would be some difference. It is a hint, we have to figure it out that what will be the difference. Now, moving back, let's read the question and then we will study if the topics as well that are being tested in the question. When anybody has any questions, they can post it in the question section. Okay, Max. Max ceased trading 2 years ago and is now about to move overseas. He would like advice on the capital gains tax implications of the disposals of two assets previously used in his unincorporated business and the IHT implications of gifting one of them. Max has always been UK resident domiciled, is widowed and has one daughter Farah. Okay, fine. So Farah is daughter of Max. Is a high rate taxpayer. So if we have to make calculations for income tax 40%, for CGT 20% or 28%. Then make disposals each year to use his annual exempt amount for capital gains tax. Has made one previous lifetime gift to Farah on 6 May 2018, which resulted in gross chargeable transfer of 194,000. So this is the gift I guess they are talking about, uh, that will affect that proposed gift as well, because one gift has already been made to Farah, which will be, as far as the IHT is concerned, will be considered as a pet, and it's a gross chargeable transfer of 194. So guys, this time the question has given me gross chargeable transfer or gross chargeable amount of a transfer. Now, do I have to deduct the annual exemption amount or not? Guys, will I be deducting the annual exemption amount now? Or will I take this figure as it is? Yes, thank you, Shabina, for your answer. We will take it as it is. Now, moving on, Max unincorporated business. Max operated as a sole trader for many years, but ceased trading on 31st May 2019. Max still owns office premises and a warehouse which had been used exclusively in his business until 31st May 2019. Max now wishes to dispose of these buildings prior to moving overseas. Okay, so I guess this is his business that he has seized, and in that there were two items. One was the office premises, which I guess he's thinking of gifting to Farah, her daughter, oh sorry, his daughter, and a warehouse which he is thinking of selling. Proposed gift, yeah, proposed gift of the office premises. Max is proposing gift to gift the office premises to Farah on 30th June 2021. Max acquired the premises on 1st April 2013. So do remember that he has owned the asset for at least 8 years. Since 1st June 2019, the business have been let to an unconnected company. Okay, so the dates are important. It has been bought on April 13 and used for business purposes till the business has ceased itself. And the business ceased on 31st May 2019. Since 1st June 2019, the premises have been let to an unconnected company. The market value of the premises in June 2021 is 168,000, which exceeds the original cost. So obviously, if he do not gift the office premises to her daughter and sells it to some unconnected person, obviously it will gonna result in chargeable gain. However, because he has seized his business and now selling the assets, the BADR can be available provided that he sells the items. Another criteria, you have the if you have seized the business and now you are selling all of the adjacent assets along with cessation of business, or if you don't sell the business after immediately after seizing the business, HMRC says that you have 3 years time period after the cessation in which if you sell the assets you can claim BADR. However, if you keep the assets for 3 years and sell it after 3 years, then you will not be able to claim the BADR on any gain that has been earned. Rather, they will be taxed at normal rates that are 20% for higher rate taxpayers as far as the other assets are concerned, and if residential properties, then 28%. Guys, I would like to ask a question that I know that for residential properties the rate is 28%. Can you tell me that what is the rate for commercial properties? Is it 20% or the 28%? In the question section, please. Thank you. The rate is 20%. Do remember, only for residential properties the rate is 28%, except for that for everything the rate is 20%. Thank you. Now, but do remember this important bit that you have 3 years in order to dispose of any assets that you want to sell and claim BADR on it after the cessation. Now, Max move overseas. Max has decided to move overseas for a period of 2.5 years, commencing on 1st November 2021. Max does not intend to return to the UK at all during this period. That's fine. So he will be out of the UK for 2.5 years. Max will return to live permanently in the UK on 30th June 2024. So he will return. Now, guys, if I calculate this, how many tax years are they? He is living in on 1st November 21. This date falls in to the tax year 21-22. Then the next tax year will be 22-23, in which he will be away. Then there'll be a tax year 23-24. He will still be away. Then there'll be a tax year 24-25, in which he will finally return. So I may have to tell the status for each year separately. Do remember that. And for that, you must have a good grip on the residency test rules. I'll go through the rules with you in shortly, but do remember that it is a very popular topic. Normally, it gets tested in every second attempt, so you must have a good grip on that. If you have any questions regarding a residency test before I go through the topic, please post them in the question section. Now, Max is not entitled to use the split year treatment for determination of his residency status in any tax year. If he is not using the split year basis, then he'll be using the ties test, obviously. So we'll go through what the ties test is in a moment. And then the last proposed sale of the machine. The machine was acquired on 1st August 2017 for a cost of 72,000. Max has received an offer of 84,000 for the immediate sale of the machine in June 2021. Guys, do remember that he has seized the business in April 19. So he must disposes of the machine within 3 years if he wants to utilize the BADR. Now, Max has received an offer for 84,000 if he sells in June 2021. Alternative buyer has offered 90,000 for the machine but will not be able to complete the purchase until June 2022. So guys, I want to ask you a question, that will the 3-year period elapse by June 2022 or not? Will the 3 years period elapse by June 2022? Yes or no? If we start from April 19, April 20, April 21 and April 22, that is the cutoff. And June 2022 is definitely after the April 2022, which means that the 3-year period has been elapsed, which means that if he, although he's getting the higher amount of money, but he will be taxed at a higher rate as well, because the BADR 10% rate will no longer be available. If he sells the machine earlier, he's getting low proceeds, but the rate of gains tax will be lower as well due to the availability of BADR. So guys, in the last part, you not only have to perform the calculations, but you also have to inform the client by writing these details as well in the answer, that the rule of BADR is that you have to sell within 3 years. And then if the question asks you to calculate the after tax proceeds in both cases, we have to perform that as well. Let's quickly check that, are we required to do that? So let's quickly kick off this part first and then we will move on. Yes, we have to calculate the increase in max after tax proceeds as well if he sells the machine in June 2022 rather than June 2021. So for that, let's open a spreadsheet, perform the calculations, and then we will compare. So if he sells in June 2021, the proceeds he's getting less cost equals to gain. And in one case, the CGT will be at 10%. So the after tax proceeds will be equals to whatever my proceeds are minus whatever my tax is. Now, I will copy only these details, and this time I will write June 22, and CGT will, in this case, rather than 10%, will be 20% because we're considering that he's a high rate band pair. Another thing I had to make sure is that is there any annual exemption left or not? So we have to check that is there any details mentioned in the question as far as the annual exemptions are concerned. Max disposals makes disposals each year to use as annual exemption amount. So we do not have annual exemption amount available. Now let's quickly check the proceeds that are mentioned in the requirement and then we'll find the cost. The proceed is 72,000 in one case. Sorry, the cost is 72,000. The proceeds are 84,000 in one case and 90,000 in the other. So 84,000 in this case and 90,000 in the other. So in the second case, the gain will be 94,000 less 72,000. Or what we can do is we can copy in these details as well. And here the cost will be 90,000 less. The cost in both cases, I guess, is 72,000. Yes. So 72,000, 72,000. Gain should be this minus this. And here the gain should be this minus this amount. This is the gain. Now, let's calculate tax on that. 10% in this case, 20% in this case. So you have to update the formula, that is proceeds minus tax. Now guys, you tell me which option is better for Max, June 21 or June 22? June 22. Why? Because despite of being taxed at a higher rate in June 2022, he is still able to get higher amount of after tax proceeds. And we will also create the calculates the additional amount because it has been asked in the question, increase in proceeds. So this minus this amount, it's 3,600 is the increase in proceeds which he will able to earn if he delays the proceeds by June 2022. Thank you. Now let's move on to the other parts. we are done with this requirement number C, by gaining 6 marks. Do remember you have to explain as well along with the calculations, so don't forget the explanation bit. The reason why I emphasize again and again in explanations, because the markers have repeatedly expressed their frustration of students not explaining with calculations. They just try to explain considering it as a numerical exam like the TX, but it is not that computational exam, it is a text planning exam. Now, let's discuss that whether the gift relief is available or not. So guys, gift relief is usually available if one gifts something to someone which they are using actively in their trade as a donor, and the donee will also be using that thing in their trade. That is one condition, that the donor and donee should use this in their trade. The second is that the donee or the recipient of the gift needs to be resident of the UK. So guys, you tell me that do you think that the gift relief is available? Uh, did Max use the office premises before gifting it to Farah? So gift relief available? Yes or no? Answer me in the question section, please. Yes. However, guys, the problem is that the point on which the Max is planning to gift it to Farah, there is some portion involved in which the asset is not being used for business purposes. That is, when after cessation of the business, he has let out the premises to an unconnected person. So I'll take you to the question to walk through you the dates. So he seized the business in April 9, in 31st May 19. Yeah. Max is proposing to gift the office premises to Farah on 30th June 2021, which means that from May 19 till June 2021, the office is not being used for business purposes. And he has purchased the office premises from April 30. So guys, the gift relief will be available, but it will be restricted to the number of months out of the total period of ownership in which it was being used for business purposes. I remember that it was clearly mentioned in the questions requirement that I do not have to perform calculations for this part. It just said advise whether Max will have the gift leaf available or not, and if so, to what extent. So I will say that yes, the gift leaf will be available because he was using it for the trading purposes. However, he seized his business on 31st May 2019, so the gain will be held over with the availability of gift relief from April 13 till 31st May 2019, and the remaining period of the gift will not be subject to gift relief. So gift relief will be available, but it will be available for the number of months in which the office premises is being used for office purposes or business purposes. That is one thing. Now guys, they I also have to advise them about the potential IHT liability, and again I have to advise only, so I'll be explaining. Obviously, as far as the IHT concerned, the gift of office premises will become pet, and its value will be locked on the date they are proposing it to gift. Let me check that is there any value provided, or what would be the value in the date of gift is 168,000. That is the value. Okay. So the 168,000 will be the value that will be locked after deducting the annual exemptions. Considering that he has not made any transfers before that, 6,000 worth of annual exemptions will be available to be deducted from this price, and the value that will be locked will be 162. Now, it will be considered as a pet, and if Max were to die within 7 years, this will become chargeable on Max death, and Farah has to pay the IHT on that. It has asked me that what can be the maximum amount of IHT. The maximum amount of IHT will be 40% on the value or the gross chargeable amount of the gift. So I've told you that, let's quickly calculate this on spreadsheet, that its transfer value is 168,000 less annual exemption amounts 6,000. So the gross chargeable amount will be this less NRB. I remember in the question it was mentioned that he recently gifted something to Farah. There you go. Regarding which I said that will we be taking 194 only, or we will deduct the AEs out of that? You said 194 will be taken as it is. So the NRB that is left is 325,000 less 194,000. So it's 325,000 less 194,000. We'll mark that as a negative figure. So the taxable amount will be 31,000. And the maximum IHT that may be applicable or that may have to be paid by Farah is 40%, considering that Max dies within 7 years and there'll be no taper within 3 years, and there'll be no taper relief available as well. So the maximum tax will be 40% of this amount. That is 12,400. 12,400 will be the amount of tax that may needs to be paid by Farah if Max were to die within 3 years. However, if he will be able to survive more than 3 years, the taper relief will be available as well on this. But I was asked to tell the maximum tax that be may have to be paid by Farah. So guys, with that I have solved that part as well. So we are only left with the residency bit, this bit. So let's quickly go through the requirement again of that part. Explain the effect of max period of living overseas on his UK resident status for all relevant tax years, and advise him of the CGT consequences of the sale of the warehouse in June 2021, or alternatively in June 2022. So guys, normally what happens is that if you sell something and immediately becomes a non-resident, whenever you join back UK as a resident, all of these gains will become chargeable on the first day you enter into the UK. However, if you sell something while remaining in the UK and remain UK resident, you have to pay the tax. So if Max will sell the warehouse by remaining the UK resident, obviously it will give rise to chargeable gain and he has to pay CGT. However, if he sell the house by becoming a non-resident, the tax will not be paid immediately, but he has to pay the tax whenever he comes to the UK. So it's not like that you do not have to pay the tax. Now, HMRC has made specific rules. Let me tell you from where HMRC has developed these rules. Because the rule says that if you are a resident and you sell anything, you have to pay the tax. But if you are a non-resident and you sell something, you do not have to pay the tax. So what people used to do is, if they have a high amount of assets which they need to sell, they first used to become a non-resident, sell the assets, avoid the capital gains tax on them, and then after a certain period of time becomes a resident again. And this way, they were to avoid the chargeable gains tax altogether. What HMRC did to combat that was, HMRC says that if you sell anything that you purchased when you were resident of the UK, but you have sell that item by becoming a non-resident of the UK, we will charge you tax on that, provided you sell it within 5 years of your non-residency. So for example, I have bought a house in 2010 and I became non-resident in 2020 and I sell that house in 2022. HMRC will calculate the gain tax on that, and whenever I come back to the UK, that tax will be charged to me. However, if I become non-resident in 2020 and I sell that house in 2030, now I have sold it after 5 years of becoming non-resident. Now there will be no tax on me regarding that asset. So that is the difference, that if Max will sell this warehouse in June 2021, because this is what requirements ask, that if he sells the warehouse in June 2021, he will be in the UK. He will be the UK resident. He has to pay the CGT. However, if he sells in June 2022, he will be non-resident. He will not have to pay the CGT immediately, but because he has sold the asset in her non-residency of 5 years, he has to pay the chargeable tax whenever he becomes resident again. That is one difference. Now, let's discuss about the second part of the question. That for that we have to tell about the residency status of all the tax years. Now, let's quickly go back to the question to find out the dates he is going to leave the UK. So the Max is moving or leaving the UK on 1st November 2021. If you ever want to revise the residency rules, visit the income tax section of consequences of being resident. Here you'll find the details. You have splitting a tax year basis here as well. Then before that you have this residency rules, which have automatic residency test and non-automatic residency test. I have tried to explain them in a simplest way as I can in my notes. So if you came across any such issue, you can always refer my notes. Now, the pretty easy criteria is to check anybody's residence, that whether they qualify for automatic residency or non-residency test. For example, if you live in the UK for more than 6 months in any tax year, you'll automatically become resident. And if you live less than 15 days in the UK in any tax year, you'll automatically become non-resident. But from 15 to 183 days, if you live within the UK, there is a chance you become resident or there is a chance you don't become resident. That is why HMRC has created this ties table. The more days you spend in UK, the lesser ties you need to satisfy to become resident. Now you have to think that what is the problem in becoming resident? Why the people are being reluctant to become resident and why the HMRC wants to make them resident. The problem is that if you are resident, you have to pay taxes in UK, and if you are not resident, you do not have to pay taxes in UK. That is why people are reluctant to become resident, so they don't have to pay tax. All of the money can then go into their pocket without paying any tax. So that is why the lesser days you spent in the UK, the more safe you are of not becoming a tax resident. Now, by keeping this rule in our mind, let's check the status of Max and decide when he will become resident and when he will become non-resident. Uh, okay, so he's moving on 1st November 2021, which means this is the tax year April 21 to April 22. Now guys, if the tax year has started from April, you let me know that in that tax year, do you think from April to November, Max has already spent more than 6 months in the UK or not? Yes or no? From April 21 to November 21. The answer is yes, guys. If you count from April to November, it's more than 6 months, which means for this tax year, that is 21-22, he's resident. Why? Because he has spent more than 183 days. Now, the very next tax year is 22-23. He is not in the UK for that tax year completely. So 0 days spent in the UK, so automatically non-resident. Then there is a tax year 23-24. He is also not present in the UK in that tax year, so he will become a non-resident as well in that tax year. Finally, guys, he's coming back to the UK on 30th June 2024. That falls in tax year 24-25. So obviously he's coming into the June. From June to next April, the months that are in total are almost 9 months, which means way more than 6 months. And therefore, in tax year 24-25, he will become resident by spending more than 183 days in the UK. So if you read its answer, it has clearly stated that if you would have good knowledge of the overseas automatic residency or non-residency test, you could have scored some easy marks here. And again, it is mentioned in the examiner comments that it is a very popular topic that usually gets tested. So I do advise you, all of you, to read my notes. It will help you to understand the topic. It also contains examples as well, with the help of which you can understand this topic. So guys, with that, we have answered all parts of this question. The last 5 minutes I will dedicate to your question. It can related to be this question or related to anything in the advanced taxation exam. So go ahead and post your questions in the question section. Mohammed Abdullah has asked that is it possible to have a gift to be subjected to both CGT IHT? Mohammed, not at the same time. Why? Because if you are alive, it will be out of the scope of IHT, it will be considered as a pet, and it will fall into the scope of CGT. There it depends. If it is a business gift, then it can apply for gift relief. If not, then you have to pay CGT on that. So when you die, obviously it is out of the scope of CGT, and it will now fall into the scope of IHT. If you die within 7 years, IHT needs to be paid, depends upon the availability of taper relief. So the gift can be taxed in both taxes, but not simultaneously, I should rather say. Any other questions, students? Furkan, yes, domicile does play a role. Domicile sorts of mean, in easy language, nationality. However, if you do not have the nationality, means you do not have the domicile, but you may fulfill the residency criteria by just spending more than 183 days in the UK and become the tax resident. Guys, you can also post the name of the topics that usually creates trouble for you. I will try to cover those in tomorrow's lecture. I cannot assure you, but I'll try. Okay, guys, with that, I would like to sign off. I hope to see you tomorrow. I hope these sessions are helping you and improving your concepts and techniques to tackle the exam. Best of luck for the exam. Hoping to see you tomorrow. Till then, take care. Bye.